2 of Module Management Accounting and Applied Finance, offered by CA Australia and New Zealand. In this video, we will be covering business risk, financial risk, risk assessment, risk treatment plan, hedging, tools for hedging. Let's start with the Unit 2. What is a risk? What do you think the risk is? So it is actually in a common thing, if we say risk of being injured while driving your car more than a speed limit. It means if you're driving your car more than a speed limit in a specific area, so it is a risk that you will injure yourself or someone else. That is a risk. But in CSG, there is a definition given, the effect of uncertainty on objectives. That's the same thing. And an effect is a deviation from the expected. It can be positive. So this is an effect. So what their definition is saying, given by ISO, it is saying the effect of deviation from an expected thing. It means it can be positive, it can be negative, or it can be both. And can address, create or result in opportunities and threats. It can be opportunities or it can be threats. So it is a risk that the definition of risk can be given by ISO. Now we're starting with the business risk. Here is actually the list of few sources of business risk. That is strategic risk, operational risk, compliance risk, reputational risk, environmental risk, disaster risk, cybersecurity risk, geopolitical, safety risk, financial risk. So these are the list of the risk. So we will be discussing all these risks in the following slides. Don't be worried. We will be discussing all these in a few seconds. First of all, my question is how to identify business risk. How can we say like this is the business risk that we are discussing? How can we identify that? So the first thing is, if you will be saying what is the business risk. So identifying a business risk is not a thing that we have to discuss here, but that is the question when we will be doing our exam. Then we will be just asking in our mind that how are we going to identify the business risk, if there any business risk exists. So there are sources of risk. It can be internal or external. Internal risk come from people, processes, policies, or structures. And the external risk that actually comes from, it can be like, it will be external sources. It can be industry. It can be business environment. It can be the physical environment. Might be earthquake. So it can be anything. So these are two sources from where the risk come from. So it means it can be internal, it can be external risk. So now we are moving ahead. So the first type or first strategic risk is the risk that we have already discussed in that list previously. Strategic risk is actually, it can be internal as well, it can be external. So if it's internal strategic risk, then what it will be? It stems from an organization goals, objectives, and strategies. Okay, its internal strategic risk is compatibility of goals. What does that mean? It means, suppose I'm giving you an example. The organization is trying to pursue a low cost strategy and a differentiation strategy simultaneously. So do you think this is a kind of strategic risk that it might affect each other? What does that mean in terms of that? Like at the same time, they are saying low cost, and then after that, it's saying differentiation strategy. So these are the two different strategies. How can you combine both of these two different strategies? One is saying low cost, and the other one is saying differentiation. So this is the risk exist when you are applying these two strategies. This is a risk that exists internally, like it might be incompatible of the goals, incompatibility of goals. Okay, let's move to the other one, that is external strategic risk. Here I'm giving you another example. The example is competitors, entrance of competitors. Nowadays you can see Amazon, eBay, and these kind of online superstores have taken over the market so rapidly that a lot of people are going online and just looking at things. So it means this is external risk. Nobody's organization has involved in that, but this is a risk. Like even as a buyer, if I will be looking at something, then definitely I will be considering that thing by looking at online. If I'm getting it cheap or something like that, so then might be I will be getting that. So it is external strategic risk that comes from external environment, and so it is the entrance of competitors. It is not in the hand of the organization. So there is an other risk, the second one, operational risk. This is a risk that arises, that stems from processes, people, systems, or events. What does that mean? This is like risk arising from organization getting on its business. So it means an organization is just running. Its business, its process, its people and system or events are just happening. So what is the risk? The risk of not happening anything in a manner that it should be. For example, I'm giving you an example. If a people, those who are working in the organization, have not been adequately trained, then what happens? So there is a risk that there might be the impact of recruitment policies. It might impact on that. It might be the human errors. The major risk is human errors and lack of skills. So just apply these things in your exam so that you can identify which kind of risk is that. So operational risk means something relevant to operational activities of the organization, which might be in relation to the processes, which might be people's, systems, events. Now let's move on to the next one. What is next one? The next one is compliance risk. What does that mean, compliance risk? Compliance word actually means legal and regulatory risk. These are legal and regulatory risk. So it can also be, we can say, internal and external. How internal? We have made our HR policies, but there's a risk if someone who has been hired newly or who don't know, who might not, like there is a risk, there is a chance that we could not be complying our HR policies 100%. There is a chance, there is a risk. External. So external is actually definitely not from the inside of the organization. It might be from the external bodies. It might be ATO. It might be government legislations. It might be work and health and safety requirements. So there is a risk that non-compliance with work health and safety legislation, that is the external risk, compliance risk. Let's move on to the reputation. What does reputation means? Reputational risk is actually, reputation is actually a goodwill, a brand's image in the eyes of the people, risk of damage to an organization's image or brand. So how this risk exists? So there is a risk that if our organization do something, it might impact or it might damage to an organization's brand, to an organization image. So this is a risk. Now we are moving on to the next one, that is environmental risk. As from the name, you can say what is environmental. This is not in the hand of, it's actually the external risk. This is not in the hand of the organization, but definitely it can be from the internal. If an organization is a mining operation, then it will be arising from that way. Risk that a business actions, like that a business's actions will result in a negative environmental impact. Negative environmental impact. What does that mean? So the use of non-renewable energy resources that impact air quality, and a lot of underdeveloped countries, they are still producing energy from coal. So it means they are negatively impacting the environment. That is the environmental risk. That is just an example. Now move on to the disaster risk. Disaster is actually, it can be man-made or it can be natural. So exposure to natural, risk of exposure to natural disaster and man-made disaster. What is natural? It is the cyclones, it's earthquakes. But what is man-made? It's terrorism, civil conflicts, war, these kind of things. Disaster risk. This is also a risk that can impact an organization. Now moving to the other one, that is a cybersecurity risk. Cybersecurity, everybody can know just risk that is related to the information technology. Risk of, um, because it's a digital revolution, risk of being, our data can be hacked by using some kind of technology softwares. Now, geopolitical risk. This is risk of actions by governments, by political governments impacting business environments. Sometimes the political governments giving grants to small businesses, sometimes they're giving to the bigger businesses. So that is actions taken by the governments impacting on both the environment of business and specific companies. Okay, now we're coming to the next one. Next one is safety risk. Safety risk is actually, it is risk that people will be injured. That is a safety risk of being not safe. Risk that people will be injured or killed while producing or using the business's products or services. That is risk exist in a production organizations. People will be injured using the business's products. Now the financial risk. That is more important, and we will be discussing all these financial risks later on the upcoming slides. Results from participation in the financial markets. It can be either from exchange rate risk, it can be interest rate risk, it can be credit risk or investment risk, it can be commodity risk. So anything apart from above 9, if there is a financial or monetary value involved, so it means there is a financial risk. So what are the financial risks? This is the list available to the financial risk. So interest rate risk, refinance risk, foreign exchange risk, liquidity risk, credit risk, equity risk, and commodity risk. Now, what are the sources of financial risk? I will be just asking this question randomly. What are the sources of financial risk? Think of it. These are actually the sources of financial risk. Equity. Equity, how it works. This equity risk is actually exists in any organization, but it's mostly exists in the bigger organization where the listed entities, they have this kind of risk. Risk that movements in stock market prices will adversely affect investors' return. So if in the pandemic, as we have seen, a lot of companies, especially the airline industry, has been impacted very adversely. Their stock prices has gone down. Definitely their shareholders or their investors, they did have that risk at that time. At the same time, afterpay has gone up. So if the investors of afterpay, they were really happy. So now I'm just going to explain one thing is movement in the stocks. prices will adversely affect investors' return. That is the risk, equity risk. Now, coming up to the interest risk. Interest risk is like movement in interest rates will affect an organization's profit by increasing interest expense or reducing interest income. Okay, if the interest rate risk going up or down, it is impacting in any way positively or negatively. There is a risk. Always there is a risk of that. Now, coming to the exchange rate risk, that is more important, and we will be giving you a couple of examples at the end of this unit, how we are going to manage the foreign exchange risk. There are a few types. What is the first type? It's a transactional risk. Whatever the transaction in a day-to-day business we are doing, foreign currency receipts or payments into the home currency. So normal business activities involving conversion of foreign currency. If suppose we are selling our goods, we're an Australian company, we're selling our goods in anywhere in the world, in the US, in UK, in Europe. So we do involve that risk. That is a transactional risk. Now, if we go to the translation risk, this is only for the purpose of financial reporting. At the end of the financial reporting period, we will be converting all our assets and liabilities into the home currency. Suppose, as I have given the previous example, our organization is an Australian company. It's a head office in Australia, and that company do have offices in UK, USA, and Europe. Okay, so now after at the year end, suppose it's 31st December. So at that year end, we will be translating all the foreign currency into Australian dollar so that we can see the actual picture in Australian dollar. But there is a risk. What is the risk? The foreign exchange can be less or more. That is the risk. Now, third is economic risk, related to an organization managing foreign exchange in a manner different from that of its competitors. What does that mean? This is the risk related to an organization managing foreign exchange exposure in a manner different from that of its competitors. Even if an organization does not have any international business transaction, it may still be exposed to exchange rate risk because its domestic customers could switch to a foreign supplier if their product was cheaper. So now we're heading to the fourth type, that is commodity risk. As the name says, change in the price of a key commodity. Change in the price of a key commodity will adversely affect the company's performance. If it's the key commodity, let's suppose if an organization is using a part A, and that is the key commodity that is used to produce some kind of products in that company. So if that price has increased or decreased, it will like adversely, or it can be positively affect the company's performance. Definitely, that's the commodity risk. Now, liquidity risk. What is liquidity? Liquidity is like not having sufficient financial resources to meet its liabilities as they fall due. So that is a thing you have to understand. Creditors and borrowings. So I cannot meet my liabilities right now, then it means I do have the liquidity risk. Credit risk. The next one is credit risk. So what is credit risk? Risk that the other party to a financial transaction will not meet its obligations on time or at all. So the credit, normally what the credit risk exists only when the party to the financial transaction will not be able to meet its obligations on time. So that is a risk. If we will be giving a loan to ABC company, definitely we will be checking its credit rating. That is a kind of credit we are measuring how much credit risk we are calculating, how much credit risk we are taking. That is the purpose of checking the credit ranking of that client. Now, refinance. Refinance is a risk, the risk that an organization will not be able to access debt markets when existing debt facilities expire. So it means like company will not be able to access any more debts unless they have to repay back the previous ones. That is a refinance risk. Now, these are the risks that have been finished. Now, I'll be just giving you a random thing. What is risk appetite? Anybody's risk appetite can be different. Like ABC company, the bigger organization, they do have the risk appetite, but a different kind of risk appetite. The smaller companies have smaller risk appetite. So the organization determines, that is a kind of limit where they can take risk up to. The organization determines the right amount of risk to take in order to achieve the desired level of return. If I have to take, suppose, $1,000 weekly, then I have to take this much risk. Suppose I have to take probably 20% risk. That is a kind of 20% is my risk appetite. Now, factors to consider for that risk appetite measurement or calculation is consider the size of the loss it is prepared to accept, how much loss I am able to accept. That is actually the factor to consider. And evaluate, I can evaluate all the risks and decides which risk to pursue or retain. If the market will be fluctuating on a daily basis, I'll be taking that risk. But if it will be dependent on some kind of news, then I have to think about that. These are factors that need to be considered before deciding what level of, or what level I can say that is my risk appetite, what level, what percentage I do have. Meanwhile, I will be discussing one thing as well, that is a risk scorecard that is actually equal to likelihood, mean the chances, and multiplied by cost. Okay, higher the risk score, higher will be the risk itself, and you can say if you want to take that risk, okay, that's your risk appetite. And lower the risk score, it means lower risk and return. Let's move on to I'll be giving you furthermore example, risk management framework. These are the couple of risk management frameworks that we'll be discussing now. This is given by the ISO 31000 2018 risk management guidelines. These are few steps that need to be followed. We can say communication and consultation. First of all, any risk comes into an organization. First of all, we have to communicate and consult with the relevant individuals to assist relevant stakeholders. So these stakeholders can be employees, can be managers, can be external parties, can be suppliers, anyone within or without of the organization. So communication and consultation. First of all, we have to communicate and consult. So the second step is scope, context, or criteria. We have to identify what is the scope, context, and criteria of that parameters. Internal parameters include organization's culture, scope. If we're talking about the scope, then internal and external parameters. The internal parameters are organizational culture, government structure, contracts. These are the internal parameters. And the external parameters are external factors and external stakeholders as well as environmental conditions. So this is the scope. What is the scope if we say? That is the scope. Now, what is the context? The context is actually, it is the objective of organization. Objectives. And so first of all, we have to understanding the context is important because risk management takes place in the context of the objectives and activities of the organization. Maybe for some organization that context will be working, so that's why it might not work according to that context accordingly in another organization. Control factors can be source of risk. Now come to the criteria. It can be positive or negative. To set a criteria, the organization should consider the nature and type of uncertainties, both positive and negative things you have to consider, time related factors, combination of sequences of multiple risks. Now we're moving to another step, that is risk assessment. How we are going to do the risk assessment? First of all, we will be doing comprehensive list of risk, understanding the nature, is it tolerable or not? Okay, these questions that you have to ask when you are doing risk assessment. First of all, you will be doing risk identification. The processes, the sources, you have identified which sources this risk is coming from. Comprehensive list of risk, you have to make that. Like identify and then comprehensive, make a list of that. Then risk analysis, you have to understand the characteristics and nature of each risk. Then after that, risk evaluation, whether you have whether it is in the tolerable limit or not. If it's in tolerable limit or is within the risk appetite, then it's good. If it's not, then we have to definitely think the other steps. Now we're moving to the fourth step, that is a risk treatment. We will be discussing the risk treatment plans later on. Just one more slide. Monitoring and review. So monitoring and review is regular monitoring of risk and the risk management framework. Like whatever we have took the risk treatment plans or risk assessment, and then after that it's treatment, then we have to regularly monitor and review those risk management framework. Okay. Then sixth step is recording and reporting. We have to record and report accordingly. How we are going to do that? Communicate risk management activities, decision making, improve activities, assist interaction with stakeholders. So I'm repeating this thing, record and reporting. So we will be recording all the transactions, all the monitoring and review procedures. Then we will communicate risk management activities and outcomes across the organization. We will be communicating that what were the risks and what we did to improve that. So it is the record and reporting. Then provide information for decision making. We will be providing information, decision making. Improve risk management activities. Assist interaction with stakeholders, including boards and other officers. The next is risk assessment. So this is actually the risk assessment that we have spoken to you earlier. Risk scorecard. Likelihood is the chances of occurrence, probability of the risk occurring, multiplied by the impact. Impact is actually the cost should the risk occur. Risk scorecard. That is risk score. So now this is a risk matrix. Okay, how we say is on the x-axis we are saying the consequences or impact or the cost that is rated from 0 to 10, and on a y-axis we have done likelihood, probability, the chances. So suppose until first of all the ranking is from 0 to 3 there's a low impact, from 3 to 7 it's medium impact, you can say, and from 7 to 10 its impact is pretty much high. Okay, the cost will be high. Now from on the the same thing will be happening as a likelihood on the y-axis from 0 to 3 and 3 to 7 and 7 to 10. That's low, medium, and high. So if it means both are low, like 0 to 3 impact and 0 to 3 likelihood, it means the low risk metrics. So we are not taking any risk. Even the cost we are keeping the cost as low as much as we can. And again, if we are saying the impact is medium, but the likelihood is low, it means the impact will be low, risk metrics will be low. The same thing will be happening if both are the things will be 7 to 10, impact will be 7 to 10, and likelihood will be 7 to 10. So it will be having extreme risk metrics. So a lot of people will not be falling in that grade that is extreme. They will be at that time, every organization don't want to do that unless they do have any kind of other plans. That is the risk metrics that have been explained. Now we are coming to the risk treatment plans. Before that, we have done so higher the risk, we will be ranking according to the risk and risk metrics. Now we are coming up to the thing risk treatment or risk responses. So first risk treatment plan is avoid, not starting or not continuing activity. If the risk is high, I'm not going to do it. I'm avoiding it. Not starting or not continuing an activity. Okay. Example: don't commence a high risk project. Okay, don't commence a high risk project. So the second is take or increase. Enter an activity or situation or increase exposure to the activity or situation. Take that risk and say, okay, I'm taking that risk and this will gonna work for me in the future. Okay, taking the risk. Pursue a high risk project. Extend a high risk project. This is the kind of example that I'm giving you. Now come to the change or likelihood. Change the likelihood. We can say, how can we change the likelihood? Means the change of occurrence. The percentage of occurrence, we are changing that occurrence chances. Implement controls. Within the organization, how can we reduce those occurrence chances? Means we can implement very tough controls. We can make processes or systems to reduce the frequency or likelihood of a risk or event occurring. So this is the example also, and we can say implement a safe system of work. Let's change the likelihood. Now change consequences. Consequences mean the impact. Implement controls, process, or system to reduce the impact of a risk event if it occurs. Change the consequences. Provide for credit losses at the time of making a loan. Invest in physical systems that divert or control flaws in case of a dam failure. What are the physical systems that divert or control flaws? That you have to think about it. Now the other is share. Move the risk to another entity. That's what the insurance companies are doing. We're just moving our risk to another entity, and on that we are paying some kind of premium. Now retain. What is retain? I'm just accepting that risk and I will not be doing anything to address it or acknowledge nothing can be done to address the risk as it is too difficult or costly to do so. I will just not be doing anything. A business may not be big enough to have appropriate segregation of duties. Start. This is the topic that we are going to start now. Is very difficult. Just concentrate on that. So this is what is hedging. In simple words, if I explain this thing, then it means hedging is just a simple word. It's an insurance. policy. Hedging is a risk treatment available for financial risks. This is only available for financial risk. It is essentially the same as taking out an insurance policy. Hedging can be used to protect against interest rate. It can be used to protect against interest rate, exchange rate, commodity, and equity risks. Okay. The first question that you have to ask from yourself, from your organization, is deciding whether to hedge or not. So if we say reasons to hedge, then these are a couple of reasons that we can hedge. Increase certainty to forecast. If it's certain to forecast something that in the future there is something that you're saying it will be increasing, then yes, go for it. The reason of the hedging might be reduces the volatility of corporate cash flows. If it will reduce the volatility of corporate cash flows, suppose if we take this step or take the hedging, then it might be effective in the long run or in the future. We have to pay a little bit less fee as compared to the one if we don't take hedging. Reason not to hedge. So the warning is wrong decision may lead to expensive consequences unless you have a proper knowledge, proper research. You don't need to invest anywhere. So no hedge. Now I will be explaining a little bit of out of the topic, but these are the types of hedging. Types of hedging are depending largely on the organization risk appetite. The types of hedging that could be used to manage interest rate risk include. Types of hedging are just for interest rate risk include. It's first, no hedging. Don't do hedging. Okay. Or it can be natural hedging. What is natural hedging? Natural hedging is if you are using an interest rate or exchange risk, what you will be doing. If you are in a foreign exchange country, then you have to just translate in the foreign exchange currency, so that you will not have any risk of that. So it will be natural hedging. Selective hedging. For example, hedging 45% of a particular risk. I'm just not doing 100% hedging. I'm just doing a 45% of the portion as a particular hedging. Hedging particularly risky exposures as opposed to other less risky ones. I am saying I am doing hedging only for the risky exposure or risky projects, but not to the less risky. So I'm just again doing a kind of selective hedging, but particularly for risky exposures, not for any percentage. And I'm doing 100% hedging. It means I'm accepting it. Yes, I'm doing the hedging. Now we're coming to the tools for hedging. What are the tools available for hedging are, first is interest rate risk. What is that interest rate risk? There are two types of interest rates hedging tools. One is interest rate swaps. The other one is forward rate agreement. What is interest rate swap? So this is interest rate swap is actually, if I say agreement between two parties to exchange a series of cash flow, they will be exchanging a lot of series of cash flows. So it will be protecting cash flows, interest cost on borrowing, interest income from investment. So just keep in your mind example, suppose if a person $500,000 is due, but at the end of some time he have to pay 530,000. If he, suppose I'm giving you an example. So yes, an interest rate swap involves only the exchange of interest cash flow streams between two parties. Suppose if one party is paying the 500,000 due and the other party paying 530,000, the counterparty that owes the most net settles the 30,000. So that is how simple is that. So in that, the key point is principal amount is never exchanged. So they will be exchanging only the difference. How you get it? So it's interest rate swaps. Okay. Now come to the second one, that is forward rate agreement. The forward rate agreement, FRA, that is, we can say sometime it's OTC. FRA is the forward rate for investment or borrowing is agreed. So this will be the forward rate in the future rate, we can say, that will be agreed in the future. If the rate goes high, I will paying that rate. But high or low, whatever it means, but I will be giving you, let's suppose 5%. Okay, so I'll be giving you a example on that. The example is, suppose the possible market rate even if I will be giving you 4.25% rate in the future, but later on the time the rate goes up, it might go to 4.7%, but still I will be paying 4.25%. If it goes down, but still I'll be giving you 4.25%. That is the future agreement. So forward rate for investment or borrowing that can be used, that can be a good hedge, that can be a good agreement. So just keep on mind the forward rate agreements is the rate that we agree today for the future time. We say whatever will be the rate in the future, but I will be paying you according to this rate. In our example, it was 4.25%. That is the rate that we have decided now. Now we're saying foreign exchange risk. The foreign exchange risk is forward foreign exchange contracts. How it is? This is forward foreign exchange contracts is, it's like exactly legally binding agreement, specific quantity, and the rate of exchange is fixed. Okay, rate of exchange is fixed. What does that mean? If we say it like, suppose Australian USD, we will be saying we are just fixing our rate to whatever you have earned, so we will be charging you 0.77 for each dollar. That is the fixed, we can say, the rate, forward foreign exchange rate contracts. Now OTC foreign exchange, that is whatever will be OTC is over the contract, over the counter. So this can be also decided in the future term. Whatever will be the rate, we will be deciding on that. Okay, that's it is. Now the thing that I will be discussing with you is a different thing, but it's very important. Interest rate risk management. What are the steps that you have to take when you will be taking interest rate risk management policy? Step one is fixed or floating rate. You have to choose whether you are taking the fixed interest rate or floating interest rate. Okay. Step two will be to hedge or not to hedge. You have to decide whether you are hedging or not. Step three, if you are doing whatever, then you have to consider the natural hedge. You can also consider that, but that is also the step. You can also ignore it depending upon the situation. Step four is evaluate derivative tools. So first of all, you have to evaluate which derivative tool can apply in the interest rate, as we have studied previously. Whatever is good, you have to choose that one. Step five is determine most appropriate strategy. You have to determine now when you are saying interest rate risk management, then you are saying step five is determine most appropriate strategy. I'll be determining that this is the most appropriate strategy. Step six is review strategy regularly and modify as necessary given business and market changes, because in the interest rate and these kind of market situation, today's life, every day, there's a market change. So just keep in mind the step 6 is very important. Review the strategy regularly, discuss it with your managers, with the all of your stakeholders necessary given business and market changes. Now, the last but not the least, the foreign exchange risk management. It does have also the almost similar steps as like the interest rate risk management, but a couple of points are different. So the first step is it possible to transact in home currency? Because that is a really good technique. Is it possible? If it's possible, then go for it. If it's not, then okay, leave it. Then could you be able to hedge it or not hedge it? So consider that option. Step 3 is consider natural hedge, that is internal hedge. Natural hedge is also the, if you can say, step 1. So transacting in the home currency or transacting in the currency where the transactions are happening, natural hedge. Then evaluate derivative tools. Definitely you will be evaluating in between 2 or 3 derivative rules, derivative tools, that which one is better for you. Definitely which is less costly for you, you will be adopting that. Step 5, determine most appropriate strategy which is good for you. Just determine that strategy. You have to determine that, calculate it, and just share it with your stakeholders. Then the 6th step is also the same, that is review strategy regularly and modify as necessity given business and market changes. Thank you for watching my channel. If you didn't subscribe my channel, please subscribe it. I will be sharing a few more videos as soon as possible when it will be available for me. It will be easy for me. Thank you. Bye for now.